People will lose money in 2026. Here's why. What if you had invested just $1,000 in Google 20 years ago? Not crypto, not a startup, just Google. Today, you wouldn't just be comfortable. You'd be sitting on life-changing money. Back in 2004, Google went public at around $85 per share. Fast forward through stock splits, ad dominance, and global expansion. That same $1,000 investment? It could be worth well over $50,000 to $70,000 plus today, depending on timing. That's the power of long-term investing in innovation. But here's the real question. Is the opportunity already gone? Or is Google still a money machine in 2026? As of April 2026, analysts are extremely bullish on Alphabet Incorporated (GOOGL). Price targets? $350 to $400 plus. Why? Because Google isn't just a search engine anymore. It's leading the AI race with Gemini. It's scaling massively in cloud computing. And it's building its own AI chips, TPUs. Big firms like Goldman Sachs and BMO Capital Markets are doubling down with aggressive targets, some as high as $410. That's not hype. That's Wall Street betting on the future of AI infrastructure. But let's be real. Stocks don't just go up forever. Regulation risks, competition from companies like Meta Platforms, and AI disruption could shake things up. So the real lesson isn't just buy Google. It's this. Find companies shaping the future and hold them long enough, because the next Google might be right in front of you. Would you invest in Google in 2026? Comment yes or no, and I'll tell you what I'd do. The 2026 money crisis no one sees coming. Last week, you checked your bank account, and something felt off. You didn't overspend. No crazy shopping. No surprise bills. But somehow, the number was lower than expected. And you couldn't explain why. That quiet feeling? That money is slipping faster than it used to? You're not imagining it. And most people won't fully understand it until it's too late. Right now, most Americans are focused on one thing. Gas prices. $3.70, maybe $4, depending on where you live. Annoying? Yes. Manageable? Also yes. And that's the problem. Because gas prices are just wave one of something much bigger. What's coming next won't feel dramatic. It'll feel confusing. Groceries that slowly get more expensive. Flights that suddenly double. Debt that never shrinks. And by the time people connect the dots, the damage will already be done. To understand what's happening, you need to look at a timeline most people completely missed. In late February 2026, a major geopolitical conflict disrupted global oil supply. That alone wouldn't matter to your daily life, except for one critical detail. A narrow waterway called the Strait of Hormuz, responsible for nearly 20% of the world's oil supply, was effectively shut down. And that changed everything. Oil prices spiked fast, and gas prices followed. The national average jumped close to $4 per gallon. In some states, even higher. But here's what most people don't realize. Gas isn't the real problem. Diesel is. Diesel powers trucks, trains, farms. It moves everything you buy. And diesel prices surged over 40%, which means everything that moves is about to get more expensive. This is where it hits your daily life. Within 30 to 60 days, higher fuel costs start showing up in grocery stores. Not all at once. Slowly, quietly. Milk costs a little more. Meat creeps up. Produce feels off. You'll stand at checkout thinking, did I buy more than usual? You didn't. Prices just changed. Now here's the wave almost nobody sees coming. Fertilizer. It sounds boring, but it controls global food supply. Fertilizer production depends heavily on energy. And with supply chains disrupted, prices surged. Farmers are already paying more right now. But here's the catch. You won't feel this immediately. You'll feel it in October. Because today's farming costs become tomorrow's food prices. By the time grocery bills jump again later this year, most people will have no idea why. Planning a vacation? You might want to check prices today. Jet fuel has surged. And airlines don't absorb costs, they pass them on. Analysts expect 15% to 30% higher airfare this summer. Some routes? Even more. And once prices go up, they don't come down quickly. This is the one that quietly hits the hardest. At the start of 2026, everyone expected interest rates to fall. Cheaper mortgages. Lower credit card rates. Financial relief. But that's not happening anymore. Because rising energy costs push inflation higher. And that puts the Federal Reserve in a trap. Cut rates. Inflation gets worse. Raise rates. Economy slows down. So what happens? Rates stay high. That means mortgage rates stay elevated. Car loans stay expensive. Credit cards stay brutal, over 20% APR. And if you're carrying debt, it doesn't shrink. It grows. Now here's the part that actually makes this dangerous. Your brain is working against you. There's a psychological bias called anchoring. Your brain grabs one visible number, like gas prices, and uses it to judge the entire situation. Gas feels manageable. So your brain assumes everything is manageable. But it's not. Here's how this plays out for the average household. First, gas gets expensive. They adjust slightly. Then groceries rise. They use a credit card just temporarily. Then travel costs hit. More debt. Then rates stay high. No relief. Then food prices spike again later in the year. And suddenly, that temporary debt becomes permanent. But here's the truth most people miss. It's not about income. It's about timing. The people who come out stronger aren't the richest. They're the ones who adjust early. So what actually works? First, build a real emergency fund. Not just savings. A buffer. 3 to 6 months of essential expenses. Because when something breaks, car, medical, anything, you don't want a 22% interest rate attached to it. Second, attack high-interest debt aggressively. Paying off a 20% credit card is like earning a guaranteed 20% return. You won't find that anywhere else. Third, don't panic sell your investments. This is where most people lose. They sell during fear and buy back after recovery. That single behavior destroys long-term wealth. Stay consistent, even when it feels uncomfortable. If you're planning travel, book early. If you can cut unnecessary spending, do it now, not later. Because once all these waves hit together, adjusting becomes harder. There's a word economists are quietly worried about. Stagflation. Slow growth. High inflation. At the same time, it's one of the hardest environments for money. And if energy disruptions continue, it becomes more likely. But here's the most important thing. This isn't about predicting the future perfectly. It's about understanding how the system works. How fuel affects food. How supply chains affect prices. How interest rates affect your entire life. Because once you understand that, you stop reacting late and start moving early. Most people will spend the rest of 2026 wondering, why does everything feel more expensive? You won't, because now you know. And here's the part most American households don't want to admit out loud. The system you've been told to trust your entire life, work hard, earn a stable salary, pay your taxes, and slowly build security, that system is starting to feel like it's moving against you instead of for you. The average middle-class American isn't reckless with money. They're doing exactly what they were taught. They show up to work, collect a paycheck, contribute to retirement accounts, pay federal and state taxes, cover health insurance, and try to save whatever is left. But the problem in 2026 isn't effort, it's pressure. Because while salaries are growing slowly, the cost of living is moving faster. Groceries don't wait. Rent doesn't wait. Gas doesn't wait. And the government doesn't wait for taxes either. So what happens is this quiet squeeze where income stays predictable, but expenses become unpredictable. And that gap, that's where financial stress lives. Now think about how most US households actually operate. A large percentage of Americans live paycheck to paycheck, not because they don't earn enough, but because the system is structured in a way where cash flow is constantly being pulled in multiple directions. Mortgage or rent, car payments, insurance, student loans, credit card bills, all of it stacked on top of each other. And when interest rates stay high, that stack gets heavier. That's the part people underestimate. High interest rates aren't just numbers on the news, they directly affect your monthly life. A higher mortgage rate doesn't just mean a more expensive house, it means less flexibility. A higher credit card APR doesn't just mean more interest, it means slower progress. You're moving, but not getting ahead. And this is where the divide starts forming. Not between rich and poor, but between people who understand what's happening, and people who don't. Because while most people are reacting emotionally, cutting investments, delaying decisions, hoping things go back to normal, another group is adjusting strategically. They're not ignoring the crisis. They're positioning around it. They understand that economic disruptions don't just destroy wealth, they redistribute it. And every time in US history, from inflation spikes to recessions, there have been people who came out stronger, not because they were lucky, but because they were prepared early.